Master your trading game. Create a bulletproof plan. Hello traders, let's be real, in the world of trading, diving in without a plan is like setting sail without a map. You're gonna get lost, and lose a lot of money. A solid trading plan is the backbone of long-term success in the stock market. It's the difference between gambling your money away and making calculated decisions that grow your wealth. So today, we're breaking down how to create a bulletproof trading plan that keeps you disciplined, profitable, and most importantly, helps you sleep at night. Alright, before you even think about looking at charts or placing a trade, we need to lay down the foundation. Why? Because your trading goals are the compass guiding every decision you make in the market. First things first, know your why. Are you trading for financial freedom, a little side hustle income, or are you building towards generational wealth? Clearly define your primary objective. This is crucial because your why will determine your risk tolerance, the strategies you employ, and how much time you're willing to invest. Next up, set realistic expectations. Look, I'm not going to sit here and promise you'll be making 100% returns every month. That's just not realistic. Instead, set achievable goals based on your risk capacity, your experience level, and the current market conditions. Remember, slow and steady wins the race. And finally, consider your time commitment. How much time can you realistically dedicate to trading each day? Are you a full-time trader, or are you juggling a 9-to-5? Full-time traders often have different goals, strategies, and risk appetites compared to part-time traders. So, be honest with yourself about your availability and set realistic expectations accordingly. Now let's talk about risk tolerance. This is a big one. Some traders are comfortable with high risk, high reward strategies. They're basically the adrenaline junkies of the trading world. Others prefer a more conservative approach, focusing on slow, steady gains over time. There's no right or wrong answer here, but it's essential to know where you stand on the risk spectrum. Remember, trading is a marathon, not a sprint. By defining your goals, setting realistic expectations, and understanding your risk tolerance, you're building a solid foundation for long-term success. Now that you've got your goals locked in, it's time to find a trading style that aligns with your personality and your objectives. Think of it like finding your investment strategy soulmate. Let's start with scalping. This is for you, adrenaline junkies out there. Scalpers are like the cheetahs of the trading world. They execute lightning-fast trades, often holding positions for just seconds or minutes, aiming for small profits on each trade. This style requires a laser-sharp focus, high execution speed, and a strong understanding of order flow. Next, we have intraday trading. Think of this as the middle ground between scalping and swing trading. Intraday traders, as the name suggests, open and close their trades within the same trading day. They capitalize on intraday price movements, taking advantage of short-term trends and volatility. This style is ideal for those who can actively monitor the markets during trading hours. Now, if you're someone who prefers a more relaxed approach, swing trading might be your jam. Swing traders hold their positions for a few days, weeks, or even months, aiming to profit from short to medium-term price swings. They rely on technical analysis, chart patterns, and market sentiment to identify potential trading opportunities. Finally, we have positional trading. This style is all about playing the long game. Positional traders, like seasoned chess players, carefully plan their moves, holding their positions for months or even years. They focus on fundamental analysis, economic trends, and long-term market cycles to make their investment decisions. Remember, the key is to choose a trading style that aligns with your personality, your risk tolerance, and your time commitment. Don't try to be a scalper if you have the patience of a saint, and don't force yourself to be a positional trader if you thrive on the excitement of quick trades. Alright, let's talk about the golden rule of trading risk management. This is not the sexiest part of trading, I know, but trust me, it's the most important. Think of risk management as your financial seatbelt. It might not be the most exciting thing, but it can save your life, or at least your trading account, in a market crash. First up, position sizing. This is how much of your capital you're risking on a single trade. The golden rule here is to never, and I mean never, risk more than 1 to 2% of your total trading capital on any single trade. Why? Because even the best traders have losing streaks, and proper position sizing ensures you can weather the storm and come out on top. Next, we have stop-loss discipline. Stop-loss orders are like your automated trading assistants. They automatically sell your position if the price drops to a certain level, limiting your potential losses. Never, and I repeat, never trade without a stop-loss order. It's like jumping out of a plane without a parachute. You might get lucky a few times, but eventually it's going to catch up to you. Now let's talk about the risk-reward ratio. This is the balance between your potential profit and your potential loss on a trade. Always aim for a minimum 1 to 2 risk-reward ratio. This means you're risking $1 to potentially make $2. Why is this important? Because even if you have a 50% win rate, A positive risk-reward ratio ensures you'll be profitable in the long run. And finally, diversification. Don't put all your eggs in one basket. Avoid putting all your money into a single stock, sector, or asset class. Spread your risk across different investments to minimize your exposure to any one particular risk. Remember, risk management isn't about eliminating risk altogether. It's about managing it intelligently. By implementing these risk management techniques, you're protecting your capital, minimizing potential losses, and setting yourself up for long-term success. Chapter 4. Now that we've covered the fundamentals, let's dive into the exciting part, developing your entry and exit strategy. This is where you'll define the rules for entering and exiting trades, taking the emotion out of your decision-making process. First up, entry signals. How do you know when it's the right time to enter a trade? This is where technical analysis comes in. Use technical indicators like moving averages, the relative strength index, the moving average convergence divergence, or price action patterns to identify potential entry points. Next, we have predefined exits. Just as important as your entry point is your exit strategy. Before entering a trade, always set both your stop loss and take profit targets. Your stop loss, as we discussed earlier, limits your potential losses, while your take profit target locks in your profits when the price reaches your desired level. Having these levels predefined removes emotions from your trading decisions. Now let's talk about trend confirmation. Don't just jump into a trade because you think the price is going up or down. Look for strong confirmation signals like higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Confirm your trading decisions with multiple indicators and price action patterns. And finally, avoid chasing. We've all been there. You see a stock skyrocketing and you feel like you're missing out if you don't get in right away. But chasing prices is a recipe for disaster. If you miss an entry point, don't chase the price. Wait for the next opportunity to present itself. Remember, patience is a virtue in trading. Chapter 5. Now here's a secret weapon that most beginner traders overlook. The trading journal. Think of it like a diary for your trades. It's a record of every trade you make, your thought process, and the outcome. First and foremost, record every trade. Note down the date, the time, the stock or asset you traded, your entry price, your exit price, your stop loss level, your profit or loss, and most importantly, the reason for taking the trade. What did you see on the chart? What indicators did you use? What was your thought process? Next up, analyze your mistakes. Nobody's perfect, and you're going to make mistakes in trading. The key is to learn from them. Review your losing trades and identify common errors. Were you trading based on emotions? Did you ignore your stop loss? Did you overtrade? By analyzing your mistakes, you can identify patterns and develop strategies to avoid repeating them. Now let's talk about tracking your performance. Your trading journal is a gold mine of data. Use it to track your win-loss ratio, your average risk-reward ratio, your profitability, and your overall consistency. This data will give you valuable insights into your trading performance and help you identify areas for improvement. And finally, continuous improvement. Your trading journal is a living document. Review it regularly, analyze your trades, and make adjustments to your strategy as needed. The market is constantly evolving, and so should you. Use your trading journal as a tool for continuous improvement, constantly refining your strategy, and becoming a better trader. Chapter 6. Now let's talk about the elephant in the room, emotions. Emotions are the biggest enemy of a trader. Fear, greed, hope, and despair can cloud your judgment and lead to costly mistakes. First and foremost, fear and greed control. Fear can make you hesitate to enter trades or exit trades too early, while greed can make you overtrade or hold on to losing positions for too long. The key is to be aware of your emotions and develop strategies to manage them. Next, avoid revenge trading. We've all been there. You take a loss and you immediately want to jump back in and try to win your money back. This is called revenge trading, and it's a recipe for disaster. If you're feeling emotional after a loss, step away from the charts, take a break, and come back when you're in a clear state of mind. Now let's talk about discipline. The best traders are disciplined traders. They have a plan, they stick to it, and they don't let emotions dictate their decisions. Develop a set of trading rules and follow them religiously. Don't deviate from your plan based on market noise or your emotions. And finally, take breaks. Trading can be mentally draining, especially if you're glued to the charts all day. Take regular breaks, step away from the computer, and do something you enjoy. A clear mind leads to better decisions. So there you have it, guys. That's your roadmap to creating a bulletproof trading plan. Remember, consistency is key in trading. Stick to your plan, manage your risk, and don't let emotions cloud your judgment. And remember, the most important investment you can make is in your trading education. Keep learning, keep practicing, and never stop improving. Final tip: A trading plan is only as good as your discipline to follow it. Stick to your strategy, and let consistency bring you profits. Do you have a trading plan in place? Let me know in the comments.